Dear friends, wish you a very happy new year. It is that time of the year when it is good to reflect on what has happened in the year gone by and what to expect going into the new year. In 2024, the world witnessed massive changes. These changes have potential to alter the course of developments going forward. The year reshaped global politics, escalated geopolitical tension, and accelerated the move towards energy transition. Global economic growth, though remained resilient, and crude oil prices, despite escalating tensions, remained range-bound. Let us now look at returns of different asset classes. CY24 has been a year characterized by decent return delivery by most of the asset classes. With this, let us now look at some of the events that shaped the world in 2024. First, a year of election. 2024 is notable for the large number of elections being held worldwide in more than 100 countries from around the world. These countries have been home to nearly half of the global population. The most notable outcome was Donald Trump's victory. This has led to volatility in the global arena, including trade. As discussed last month, we believe this outcome will be net positive for India. Second important change has been about climatic conditions. Relentless global warming provoked heat waves, droughts, particularly in India. This heated up the sales of cooling solutions, resulting in a drawdown of inventories for many players in this space. The wet weather proved dramatic, with unseasonal rains and flash floods in the desert-prone areas of Dubai, Saudi Arabia, Pakistan, and Afghanistan, which bore the brunt predominantly. Extreme weather fluctuations are becoming a norm. The world needs to be cognizant of this. This may have an impact on food inflation structurally. Another important aspect is about logistic costs. Escalating geopolitical worries have led to uncertainties in the global trade flows. The attack on cargoes moving through the Red Sea in the Middle East led to not only sharply higher freight costs, but also increasing timelines. This will mean redrawing supply chains and inventories globally. Bangladesh crisis has been another notable event. The widespread unrest through the country in disarray. Bangladesh is now facing inflation and violence. This disruption has impacted the textile industry, making global brands think about alternatives. This opens up opportunities for countries like India, Vietnam, Cambodia. Another important aspect has been the record money raising in India. 2024 was the best year for fundraising in the Indian primary market. Overall fundraising, including IPOs, FPOs, OFS, and QIP, jumped 2.6 times to Rs 3.3 lakh crore. While the fundraising led to improving balance sheet strength and increased entrepreneurism, the sheer large availability of capital also need to be watched out for its misuse, largely on the capital misallocation side. In the Indian market, we saw interest in following areas. Renewable stocks. In this space, we have seen new listings and value creation. The multitude of government-related measures and supportive policy led to increased market size and made domestic players withstand the Chinese competition. Electronic manufacturing also has been another very important area. Another important area has been hospitality. The entire tourism space hogged the limelight. Air passengers, hotel occupancy, and room rates reached new heights. The availability of improved infrastructure, coupled with the trend shift towards experiences, has led to structural growth for the industry. We entered 2024 with a positive momentum on earnings. Consequently, the equity markets did well in the first half of fiscal year in response to corporate earnings and economic growth. Other factors that were beneficial last year include range-bound commodity prices, bond inclusion related inflows in the country, domestic equity flows supporting markets. Post the election, in H2, volatility increased with earnings growth slowing that led to earnings downgrade. Earnings growth now have dropped to single digit. As we progress into 2025, we expect a gradual recovery in growth rates. The government capital expenditure, which has been slow so far, needs to accelerate. Between April and October 2024, the government capex has been down 15% on a year-on-year basis. This means to meet the budgeted target, the government need to increase the capital expenditure spending by 60% for the remaining period. While the government may not be able to meet its budgeted capex, acceleration is a necessity. Also, we expect revenue expenditure, which has been growing at 4.7% CAGR between FY21 and FY25, should see acceleration going forward. On the state side, the welfare spending is taking precedence. In the first 8 months of this fiscal, the welfare-linked revenue expenditure rose by close to about 13%. This should have a positive impact on consumption going forward. We expect the rate of growth for discretionary businesses to get better. As we progress, we expect calendar year 2025 to be a year of gradual improvement. As it appears now, outlook on macro earnings should improve, but only gradually. Areas that need close monitoring going forward. First, household leverage, especially the performance of unsecured lending that can be a lead indicator. This needs to be closely monitored for any turns. A fair amount of pain has already been taken. Second important aspect is supply chain. This can lead to higher competition. The competition may emanate even from imports. This implies that businesses which have pricing power should be preferred. Fiscal outlook. The government needs to balance trifecta of growth in capex, revenue expenditure, and tight control on fiscal deficit. Tax collection will also play a very important role. We expect macro positives in consumption trends and private capital expenditure. In an environment of a slow earnings growth, it is important to focus on bottom-up ideation rather than top-down approach. We believe selective businesses in discretionary consumption, manufacturing, and pharmaceuticals should do well. Consumption should see benefit of improved hiring by IT companies, which has been the case after almost 6 quarters, moderate inflation, and continued income growth. Agri-income should inch up due to combination of high prices. We have seen an increase in prices of agri-commodities like wheat and rice. Non-agri income should benefit from an increase in high government spends driven by welfare expenditure of state and central. Manufacturing should continue to do well, driven by redrawing of supply lines globally, focus on import substitution, and rebuilding or creating infrastructure in India and globally. The businesses operating in electronic manufacturing, energy transition, circular economy, and semiconductors are expected to do well. Also, as the profit growth divergence across business sizes reduces, we expect reduced price performance divergence as well. India Incorporate, in general, is now settling at a relatively lower profit growth, close to about low double digits. At ASK, we have a sharp focus on high quality and growth-oriented businesses that are operating in manufacturing, discretionary, pharmaceutical, while we are underweight on banks. We have focused on businesses that have execution prowess and ability to increase market share across varied business environments. Also, companies with high ROC and value-adding profit growth should continue to command a valuation premium. The focus has to be on growth rather than pure cigar butts. Again, Happy New Year and happy investing. Thank you.